Hello and welcome to this live session on the economic outlook for India. As the global economy was gradually putting the COVID-19 pandemic behind, with many parts of the world lifting restrictions and several economies returning to the pre-COVID size, another shock struck. The ongoing conflict between the Russian government and the Ukraine is far from over, lowering global growth prospects and increasing inflationary pressures. To have an insight on how economies are expected to shape up going forward and how India will be impacted, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you, Geetu.
Mr. Basu, the ongoing geopolitical uncertainties are creating disruptions to production and trade. We all know it. Even if the conflict between Russia and Ukraine itself remains localized, it has broad implications for economies all across the world. And we have started witnessing the same, the surging inflation, the supply chain disruptions, and the issues which have started cropping up. What is your view now? Provide us with some guidance on how major economies will perform in an increasingly difficult times that we are going through, and how is India placed amid all this?
Well, as of today, it is now 2 months since the Russia-Ukraine war began. And there clearly have been quite serious disruptions to the global economy as a result. Most importantly, of course, oil prices have spiked upward because Russia is a major supplier of crude oil to the world. It accounts for about 11% of world crude oil exports. And it's a massive supplier of natural gas to Europe. About 70% of Russian natural gas exports go to Europe. Europe is heavily dependent. Germany depends on Russian gas for about 40% of its electricity needs. And so across Europe, there's been a very significant impact. Interestingly, it has just been reported that there was a huge increase, ironically, in European imports from Russia. So although sanctions have been imposed by the United States in particular and the UK, big trading partners supposedly of Russia. In fact, the reason why the US and UK are able to impose sanctions is because they themselves are much less effective. They don't have that much dependence on on Russian energy supplies, and so they're able to impose sanctions and not suffer too many consequences. But Europe cannot really afford to stop all supplies of Russian energy. And ironically, supplies of Russian energy have actually increased according to the data. In March, they were up sharply. They were up about 15% on February. So it appears that despite the rhetoric of sanctions, Russian supplies continue to come through, and Russia benefits, of course, in terms of payment for those, and Europe hasn't seen its economy be as disrupted as it otherwise would have been. So that's one aspect. But the global energy prices, of course, have spiked. They were already high. Brent crude, even before February, had been above $60 a barrel. The Brent crude price had been over $60 a barrel for over a year, starting from the first week of February 2021. They've been above $60 a barrel. For about 6 months before February, they had already been above $75 a barrel. So essentially, we've now had 14 months of Brent above $60 a barrel, 8 months above $75 a barrel, and about 2 months at or above $100 a barrel. So high oil prices, of course, have had a big negative impact on oil importing countries like India. But it's important to understand that while India is a significant importer of crude oil, the value of India's exports of petroleum product, that is refined petroleum, is equal to a little over 40% of the amount imported into India. So 40% of the import value is actually exported out by India in the form of refined petroleum. So also interestingly, if you look at US imports of energy from Russia, about 65% of those imports are not crude oil, but refined petroleum. And the US is a big importer of refined petroleum from India. So the sanctions on the US, interestingly, are going to divert US demand away from Russia to India. India is also the single largest importer of crude oil from the United States. So there's a symbiotic relationship, and I think both sides to some degree are benefiting from this. Now, the other side for India is, of course, that inflation was already around 6%, and in March, the CPI inflation rate reached 6.95%. The third consecutive month that it's been above 6%. That level of inflation is much lower in India than in the United States and Europe. In the United States, headline inflation is 8.4%. In Europe, it is 7.5%. Now, 7.5% and 8.4% there is actually a lot higher than what is normal. Normally, in these countries, over the last 20 years, inflation has rarely been above 2%. Now you have inflation at 8% in the US. It's slightly below 8% in the European Union or the Eurozone. In India, inflation generally averages 5 or 6%. And now it is just marginally above that. So the monetary policy implications are not so severe for India as they are for Europe and the United States. Europe in particular, because even in March, the ECB was saying that we are going to continue to add to our balance sheet. So they're going to continue to buy bonds and aggressively expand the amount of money supply in Europe at a time when inflation is already above 7%, when they actually have an inflation target of 2%. The United States has an inflation target of 2%. And it's made a terrible policy error because it was continuing to buy bonds and expand its monetary base and also keep M2 growth very high until February. So what we're likely to see is both the US and Europe aggressively change from a very accommodative and loose monetary policy to a rapid move to tightening, especially in the US. We're likely to see that start as early as 2 weeks from now when the next FOMC meeting happens. And in Europe, it'll be even more disruptive because Europe has negative interest. The policy rate is negative, is below zero. The nominal policy rate is below zero. It's even difficult to conceive what that means. The central bank pays you money to borrow from it. It's a bizarre situation. Now, that is probably going to change rather abruptly sometime in the next 2 or 3 months. And as that happens, there will be a bit of a shock to the system in the European economies. In the US, of course, the shock is already being absorbed. I mean, there's a switch away from highly loosening policy towards one rate hike in March of 25 basis points, most likely 50 basis points in May, and another 50 basis points at the end of June. So we'll have interest rates in the US rising by 1.25 percentage points in the current 3-month period from March to June. So end March to end June. So that is going to be a bit of a shock to the system, and it'll mean that global economies, especially the developed economies, advanced economies, will be decelerating very sharply.
Would that mean that these countries like US and European region subcontinent countries would enter recession? Because there have been some reports which are calling from that brace yourself for the recession in developed nations.
Yes, I think the best predictor of recessions in the US is the yield curve. The difference in the yield on 10-year bonds versus 2-year bonds. So when the yield on 2-year bonds rises above the yield on 10-year bonds, then you basically have an inverted yield curve. Now, instead of a normal upward sloping yield curve where the 2-year yield is lower than the 10-year yield, if the 2-year yield goes higher than the 10-year yield, then you have what is called an inverted yield curve. And whenever the yield curve inverts, you get a recession in the US 18 to 24 months later. So on the 1st of April, in the first week of April, the US yield curve did invert. So we can be sure, if history is any guide, we can be sure that the US will go into recession by the first quarter of 2024.
And if that happens, Mr. Basu, India would also suffer.
Of course, everybody will suffer. I mean, the world's largest economy goes into recession. It's not a tea party for everybody else. Of course, there will be an opportunity for the US to come to its senses. So essentially, the reason why a recession is likely in the US is because of this very sharp move from an extremely accommodative monetary stance to a rapid tightening. The rapid tightening is needed because inflation is so far above the inflation target. The target was 2%. They said they're going to, until October last year, the Fed was saying that, inflation is completely transitory, nothing to worry about. It'll go away on its own. They were wrong because, as I've said in my previous sessions here in Investonomics, recall that in the 60 years before the COVID period, in 60 years, the average broad money growth in the US was 6.5%. Year-on-year growth in broad money was 6.5%. During the last 24 months, average broad money growth in the US is 18.5% monthly for that 24-month period. So it's rising almost 3 times as fast as it normally does. When that happens, you will automatically eventually get inflation. And essentially that's what's happened. There are lots of other explanations being trotted out. Oh, this is because of supply disruptions and so on and so forth. But no, the reason is monetary. I mean, I think central banks have taken their eyes off the monetary aggregates quite bizarrely. I mean, this has almost become a doctrinal thing about central banks in the last decade or so, where they said, oh, monetary aggregates don't matter. That's silly. I think that they're looking at monetary aggregates the wrong way. Anyway, the point is that if you have such a rapid shift from moderate growth in monetary aggregates to very rapid growth, you are going to get inflation. And that's true of both the US as well as the European Union. The ECB has made the same policy error, not quite as much, I think, as the US. I mean, in the US, there was a very long period of very unusually rapid monetary growth. In the European Union, monetary growth was way above normal, but it wasn't 3 times as fast as normal. So it was only about 1.5 to 2 times as fast. So it was rapid, but it wasn't extreme. Nonetheless, both now have an extreme inflation problem, and both need to rather violently change. Now, of the major central banks, I think the one that is probably sitting most pretty at the moment is the Bank of Japan, because Japan has had a deflation problem for the last 25 years, and especially the last, I'd say the last 15 years since 97, 98. I mean, 97, that was 25 years ago, but especially since that 25-year period, 97 onwards, and then it has slightly overcome that since Abenomics began in 2012, 2013, and it has managed to keep inflation positive, but the goal was always 2% inflation. And in 25 years, there have been probably something like 8 months in 25 years in which inflation has been at or slightly above 2%. Right now, inflation is 0.9% in Japan, in February. In March, almost certainly it's going to be quite a bit higher. It'll probably be well above 1%. And this is great news because, of course, inflation is never a pretty picture because inflation has different, it's different types of prices that are rising. So at the moment, energy prices, prices of textiles, garments, etc., retail products that are not produced in Japan, those things are seeing a rise in price. But Japan still produces almost everything else, and it still is an export-oriented economy. It still has a current account surplus. Its exports will do very well, and inflation will finally be close to 2%. So Japan is feeling happy. It's the one place where the central bank is not in any trouble. There's absolutely no need for the BOJ to tighten. It wants inflation to be positive because Japan has a lot of public debt. And one way to reduce the public debt is to generate some inflation. One of the reasons the public debt has stayed high is because there's been so little inflation in Japan for this entire 25-year period. Now, we are probably going to see some inflation picking up, and that'll be great for Japan. So now, when I look at the impact in India, I keep emphasizing that unlike the US, if you look at US broad money growth, I said that it was growing 3 times as fast during the COVID period as during the 60-year average before COVID. Now, come to India. The 30-year average for broad money growth in India prior to the COVID period, 30-year average was 15.4%. During the 2 years of COVID, now the 25 months since COVID began, average broad money growth in India has been 11.2%. So India's broad money is actually growing slower during the COVID period than it grew in the pre-COVID. 20 years of pre-COVID, it is growing. Actually, 30 years. It's 30 years of pre-COVID. The broad money growth was faster than during the COVID period. So there's been no extraordinary monetary accommodation in India. So the shift is going to be much more gradual. I do expect that at the next 2 MPC meetings, the RBI is going to raise rates by 25 basis points each, simply because the headline inflation rate is currently high. But every time you see oil prices stay this high for this long, a couple of things happen. First of all, marginal oil fields become viable. So the tar sands in Canada become much more viable. The shale in the northeast of the US, shale oil in the northeast of the US becomes viable. Alternatives to oil become much more viable. So the solar energy sector is going to see a boom. Wind energy will see a boom because they are now able to compete a lot better, given that the alternative energy source is so much more expensive. So all of this is going to help boost energy supplies of marginal oil and natural gas and of alternatives, and particularly renewables. So I expect that oil prices will begin to ease off quite significantly by about July to September. That July to September quarter, you're going to see an easing off of oil prices for 2 reasons. One, the tightening of monetary policy begins to slow the major economies down. So demand for everything comes down, including oil. And at the same time, oil and alternative supplies of energy begin to pick up significantly because of this long period of high oil prices. And as a result, you get a combination of factors pushing oil prices down. And the tendency, in my view, will be for oil to come down very quickly as a result. By September, I would expect to see Brent crude back down to $60 a barrel. And so for India, that's great.
If that happens,
that is lovely. So we have currently a very tight, difficult period. Inflation is high. Central bank has to tighten as a consequence. Essentially bring forward the rate hikes that would otherwise have occurred a little bit later in the year. But once that happens, by August, September, you're going to see headline inflation coming off because global crude prices come down, and you get a cascading impact of lower oil price, reducing the prices of manufactured goods and other types of prices across the system, and that helps to bring inflation well under control, and therefore means that in the second half of the fiscal year, the RBI can return to a quietly accommodative stance, much more so than it has that'll have between now and August.
So what I get is, like, in a very short-term period, RBI may have to hike interest rate and be hawkish, and this stance would shift towards the end of the year. And where do you see the inflation averaging for FY23 in case of India, sir?
So if you look at, first of all, the RBI has already quietly tightened conditions somewhat at its last meeting. It didn't raise the policy rate, which is the repo rate, but instead of the reverse repo rate, they introduced a new rate that effectively makes the reverse repo rate redundant, and that rate is 40 basis points higher than the reverse repo rate. So there is now effectively a little bit of a tightening, and we've started seeing banks raise their lending rates by 10 to 15 basis points already in the past couple of weeks. In fact, especially in the last 2 or 3 days.
Yes.
So all of that is exactly what the RBI wants to do at this stage. It needs to gradually start tightening monetary conditions, given that headline inflation is above the target range. The target range for the RBI is 2 to 6%, and we have inflation above that target now for 3 months. So any inflation targeting central bank will need to act, and so the RBI is slowly beginning to act, although the RBI recognizes that domestic demand is still quite weak in the Indian economy and needs a boost. So they want to boost domestic demand, but they cannot, given that inflation is above the target range.
What would slower growth rate and higher rates mean for India? In terms of the interest rate outlook, the inflation worries which are dropping in. Where in India be impacted? Corporate India do?
Okay, your line was a little disturbed, but I think I can interpret the question. So globally, what you have is that we are entering a period of slowing economic growth. Recession is not immediate, right? Recession is still nearly 2 years away in the US, but we're going to see a deceleration of growth between now and then. Now, what India needs, therefore, is to stimulate domestic demand. Domestic demand needs to take the slack, given the fact that external demand is not going to be as robust and buoyant as it was last year. In 2021, we had a very good year of what I call re-globalization. Re-globalization in the sense that you had last year, global GDP grew a little over 5% in real terms, but the volume of global trade grew more than 10% last year. So global trade grew almost more than twice as fast as global GDP in real terms. That is the first time that has happened since 2010. In the intervening years, global trade was growing only as fast as global GDP most of the years. In fact, some years it was growing less than global GDP. So we had a very difficult period. I call that 2011 to 2020 the deglobalization phase. Re-globalization began in 2021. And I think re-globalization is continuing now. despite all this talk of the Russia-Ukraine war, Europe is importing more from Russia. So there's no end to, so globalization hasn't suddenly collapsed. It's in fact continuing. If you look at India's exports in the first quarter of this year, calendar year, India's exports were up 24.5% in dollar terms. So last year, in the calendar year, India's exports grew 41.6%. That is the fastest of any major economy in the world. In the rest of Asia, the three fastest growing exporting countries were Korea, Taiwan, and China, which all saw their exports grow slightly less than 30%, about 29, 28%. India's exports grew 41.6%, way faster. And in the first quarter of this year, India has again strongly outperformed. India's export growth has strongly outperformed the rest of Asia and most of the rest of the world. So that is continuing. And we're continuing to see a period of re-globalization. What my explanation for re-globalization is basically that there are disruptions to domestic economies. And since there are disruptions to domestic economies, countries are having to import what they are unable to produce because of these domestic disruptions. And so that has actually generated more international trade. And we're seeing a real boom across the board in global trade. And India is benefiting disproportionately, partly because of improved productivity in the export sectors, as well as more investment coming into the export sectors because of the production-linked incentive scheme, which is just really getting off the ground as of last year and really going to pick up a lot this year. So all of that is contributing to a very strong export performance. So exports are doing very well, but obviously we're not going to see a repeat of 42% export growth. This year it's going to be slower because the global economy is slowing down, decelerating, and even this 24.5% of the first quarter is unlikely to be sustained. It'll probably be slower as we go through the course of this year. Good growth, but not as dramatic. So it is necessary for India to have a revival of domestic demand, specifically of fixed investment spending. And I think my logic for why fixed investment spending is likely to pick up is a few things. First of all, we've had 4 or 5 years of pretty sluggish investment spending. In fact, if we look at the last 10 years, it's been a period of relatively sluggish investment spending growth in India and much of the world outside China. China was investing still. The rest of the world wasn't doing much. So this is called the global investment drought. India was participating in the global investment drought. But now I think there's more and more evidence. I mean, we're seeing a lot of announcements by major corporates. For instance, ArcelorMittal, it's a very iconic global company. It's the world's largest steel manufacturer as a company. And ArcelorMittal, of course, the principal shareholder comes from Kolkata, but he has, until last year, he had never invested in India. He had invested all over the world. He went to Indonesia, Trinidad, Jamaica, Mexico, Canada, East Germany, Kazakhstan. He had plants all over the world, right? But he didn't have anything in India until he bought Essar Steel. And now ArcelorMittal has, and its partner Nippon Steel of Japan, the third or fourth largest manufacturer of steel in the world, they have together announced a 24 million ton steel plant in Odisha. Now, if you think about that, 24 million tons is about 20% of what India now produces annually. So there'll be, if that plant comes in, it'll be a 20% enhancement of India's steel making capacity. And that's not the only one. That Jindal have announced a lot. So in steel, there is a new burst of optimism and new investment coming through. This is one example, but pretty much across the board, we have growing evidence that investment is likely to pick up significantly in the year ahead. So that's one. Now, the other factor I think that is propitious is that the fiscal deficit in the last fiscal year that ended in March, FY22, ending on 31st March 2022, we don't have the final numbers yet for the fiscal deficit. But what we do have are corporate tax revenue, income tax revenue, GST revenue, etc. Now, for corporate tax revenue, the actual inflow of revenue, collection of revenue, is 17.7% higher than the revised estimate provided in the budget of 1st February 2022. So 2 months before the end of the fiscal year, the government had a revised estimate, which was sharply higher than the budget estimate. And yet the actual outcome is 17.7% higher than the revised estimate. Not only is it higher than the revised estimate, the corporate tax revenue at in FY22 is higher than the projected figure for FY23 for both corporate tax and personal income tax. For GST, it's only, GST FY22 number is only marginally lower than the FY23 figure. So in effect, what this means is that if we have a normal year, which I think we'll have, at least 8.2% GDP growth is my estimate. The IMF recently caught up to my estimate. The IMF has 8.2% also, exactly the same number. I don't know if they saw my report and decided to make it the same number, but it's 8.2%. Now, the point is that it's very difficult to see anything much less than that in the Indian economy this year. So given that, and given the fact that you're going to have 4 or 5% inflation, at least, most likely over 5, you have about 13% nominal GDP growth, 13.5%. That will boost revenues, at least by about that much. I think it's quite reasonable to assume that you'll get revenue growth of 11, 12, 13% in most of the major categories of tax. As a result, the fiscal deficit in the current fiscal year, FY23, will be a lot lower than the projected number. The projected number in the budget was 6.4% of GDP. I think it'll be not much higher than 5.6% of GDP in the current fiscal year if we have very normal revenues. I mean, now if revenues continue to grow, corporate tax revenue continues to grow at the sort of pace we saw in the last 6 months, then of course it'll be way above. The revenue numbers will be way above and the fiscal deficit will be way below. But let us say, just take it as a moderate year, you'll still get a fiscal deficit at 5.6% of GDP, which means the government's market borrowing requirement will be a lot lower than projected in the budget. And as a result, in the second half of the fiscal year, we'll have inflation lower for the reasons I outlined earlier. And we'll have the market borrowing requirement of the government more or less done in the first half. So there's very little additional need for borrowing by the government, which means that there will be enormous scope for a crowding in of private investment. And that crowding in, I think, will really begin to gather steam in the second half of the fiscal year. And so, in a sense, what I'm arguing is that this year, India will not need the world as much because finally, after a 5 or 6 year period of sluggish investment spending, we are going to see a good, solid recovery in investment spending. And that will take up the slack created by the global slowdown.
Mr. Basu, you just said that US Fed might increase rate by 50 basis points, and and another meeting, another 50 basis points, which means 1.25% in this year itself, calendar year 2022. And RBI may not be that aggressive in hiking the rate because inflation is not that big a concern, and it is, as compared to the developed nations. So will this interest rate differential between US and Eurozone and India lead to some kind of an FII outflow from India?
Well, we've already seen...
Because we have been seeing the exodus.
Yeah, we've seen a huge exodus since October last year. The size of the outflow between October and now is larger than it was in during the global financial crisis of 2008. So there's been a really massive outflow over the last 7 months. And you see now, portfolio investors don't act after the news has hit them. They try to anticipate, especially equity investors, try to anticipate what's going to happen. So presumably they could anticipate that there was going to be a hiking cycle in the United States that would make it more attractive to take money out of emerging markets and put it to work in the US. And so we've seen that process occur over the last 7 months. And I think we'll still see some of that over the next 2 or 3 months. There's no question that this process isn't over. It is going to continue. But if this scenario that I've pointed out continues to play out, then what is going to happen is that domestically oriented Indian companies are going to continue to see very strong earnings growth. Their EPS growth continues to be very strong, helped by the fastest growing economy in the world. By the way, in calendar year 2021, India returned to being the world's fastest growing economy. It grew real GDP grew 8.3% last year, calendar year. China's growth was 8.1. So since 2014, this is the 4th year in which India has been the fastest growing economy in the G20. Of course, there are some small economies that might have done a little bit better, some really tiny ones somewhere along the way. Some years, Afghanistan was the fastest growing in some years. Of course, not last year, but in some of the other years. So now the point is that of the G20, which is the world's 20 largest economies, India returned to being the fastest growing last year. According to the IMF, India will remain the fastest growing this year and next year. And I completely agree. And the one thing where I differ with the IMF view, IMF is looking at a deceleration next year. 8.2% this year, I think 7.6% for next year. I think next year, once the momentum of a new investment cycle comes in, an investment cycle doesn't end after 6 months. When it begins, you see an investment cycle that continues. And in India's case, it'll be driven by a lot of different things, including the fact that you have a more prudent government that is seeing a substantial improvement in its fiscal position, which is actually a rarity in today's world. If you look around the world, we have a plethora of countries, starting with the United States, Europe, Japan, of course, China, which have all seen an explosion of debt. In our neighborhood, we've just seen the first Asian sovereign default in about, since 1986, the Philippines. The Philippines defaulted in 1986, although it's a rare occurrence for an Asian economy to default. And unfortunately, our neighbor in the south, Sri Lanka, is now in sovereign default. Pakistan narrowly has averted that, but is now yet again going to be awarded the IMF, probably for the 24th or 25th time that it's going to be taking an IMF loan. So Pakistan and Sri Lanka, our two neighbors, are in very serious trouble. And just not just these, but around the world, we have a huge run-up in public debt and external debt in many places as well. Compared to that scenario, India is in actually really good shape. India has been incredibly fiscally prudent. There was 1 year in which the fiscal deficit reached 9% of GDP. That year, the COVID year, the US deficit was 14.5% of GDP. So India was much more prudent than the rest of the world. And now the benefits of that prudence should begin to come through, because what will happen is that while the rest of the world is still dealing with the need to deleverage from that fiscal borrowing binge, India will not have that need. And so India will be much better positioned. And so once investors, portfolio investors, FIIs begin to refocus on this fact, which I think they'll begin to do by about July, August, they will see that it is not worth continuing to pull money out of India, despite the rise in US rates.
India recently has been pushing for more FTAs, foreign trade agreements, with multiple countries and regional blocs. India has signed FTAs with UAE, with Australia, and is in negotiating with the United States and EU also, and UK. The Prime Minister is here. How do you see this impacting India? Is this the way forward to growth for India?
Yeah, I think this is a very interesting shift. There was a lot of headlines about India not joining the RCEP, the Regional Comprehensive Economic Partnership, which involves the ASEAN countries, Japan, Korea, Australia, New Zealand, and China. Now, the reason why India did not join the RCEP, I think, is very, very clear. And that is that, interestingly, India already has an FTA with ASEAN. It has an FTA, the ASEAN FTA has been in place since 2009. There's been an FTA with South Korea since 2010 and with Japan since 2010-11. So three major members of the RCEP are countries with which India already has an FTA. Now, India has signed an FTA with Australia just last month. And so of the RCEP member countries, the only ones missing are China and New Zealand. Now, if you look at India's trade with China, it is very, very imbalanced. India has a massive amount of net imports from China. And it is a simple fact that China is an enemy country of India's. I mean, Indians don't like to acknowledge this. India's foreign service in particular has never really properly acknowledged this. But China has thought of India as a rival since 1950 at least. Mao made it very clear. When Nehru was saying Hindi Chini Bhai Bhai and was encouraging that, Mao was abusing Nehru on a daily basis. And we were just ignoring it, doing this. Sunenge nahi. We don't want to hear. We just close our ears. And this, the consequence is that, we've had a lot of negative consequences in terms of the relationship with China since. Now, if you look at the trade imbalance, it is huge. There's a very, very, very negative trade balance. We have a huge bilateral trade deficit with China, and that continues to grow. Last year, the bilateral trade deficit widened further. So if we are to enter an RCEP type arrangement, where there's going to be if there's going to be an RCEP arrangement, then China needs to open itself up to much more imports from India, and basically remove some of the non-tariff barriers. Unfortunately, those are not forthcoming. Also, the rules of origin need to be clear-cut. The rules of origin need to be clear-cut so that China doesn't disguise some of its exports as coming from ASEAN into India. Since India already has an FTA with ASEAN, a lot of this is already happening. Products that are actually produced in China are rebadged as ASEAN produced and come into India. So India had no reason to join RCEP. And interestingly, India gets a bad reputation. I've just recently looked at customs duty revenues as a percent of India's imports. And if you look at that, I think that is a real measure of the amount of protectionism. This measure in 2004 was, customs duty revenues were about 17% of India's imports in 2004. Today, they are about 4%. Customs duty revenue is 4% of India's total imports, which basically means India has become less protectionist over time, not more. And in fact, there's no rise. It hasn't gone from 3 to 4% since 2014. There's a lot of silly rhetoric because India has raised a few tariffs by a small amount. That doesn't constitute an increase in protectionism. So protectionism has not increased. India has remained quite open to trade and imports right through this period, but India needs to be more cautious and more prudent in its approach to trading with China, which is not a friendly country. So this is not yet happening. I mean, I think you need to be a bit more prudent in the way we allow imports from China to keep coming in. So, and there are a lot of other reasons why imports from China are, should be barred because they're dumped. There's a form of dumping because they are actually selling their exports at below the domestic cost of production, which constitutes dumping in the parlance of international trade. And therefore, under international trade law, we would be within our rights to impose anti-dumping duties. But of course, imposing anti-dumping duties, any form of duty on imports, even if it is only on a single country, tends to raise the cost of imports and therefore will have an inflationary consequence. So if we can find alternatives, and in particular, for products where India produces those same things and can produce much more, so steel, metals, and so on, those sort of anti-dumping duties would be much more prudent. Anyway, now, getting away from China, with Australia, for instance, and the UAE, now, these are two interesting countries from which we import a lot more than we export. Of course, UAE for the obvious reason that it is a big supplier of crude oil. So India imports a lot of crude oil, but the UAE is India's third largest export market. And an FTA will essentially remove almost all tariffs on India's exports to the UAE. So, in international trade, if you get a 3 or 5% reduction in tariff rates relative to competitors, that's a huge benefit. So we'll certainly see Indian exports to the UAE picking up substantially as a result of this. And similarly with Australia, now India imports a lot of iron ore and other mineral imports, coal from Australia. So replacing, on the other hand, what India exports to Australia is a small proportion of what India imports. So Australia has cut its tariffs on most of what it imports from India to zero. That means that there will be an opportunity for a substantial increase in Indian exports to Australia over the next few years. And that will benefit both sides. I mean, if a country is able to import more from a relatively inexpensive manufacturing site such as India, then it'll benefit that trading partner. And so the Australia-UAE trade deals are relatively positive. I think they are very positive for India because they are two countries with which India has a bilateral trade deficit, a pretty large one in both instances, and they are cutting their tariffs essentially to allow more imports from India. That'll be good. In the medium term, that'll be a solid net positive. Now, the UK, US, and European Union are slightly interesting cases because the United States, of course, has a huge trade deficit with the world. Its trade deficit with India is its 9th largest bilateral trade deficit. India accounts for 2.6% of US imports from the world, and India takes 2.6% of US exports. So both are exactly the same. But the US has a deficit with everybody, so it has a deficit with India. So we are actually, on a relative basis, we are not the bad guys. The really bad guy in bilateral trade for the US is China. China is the biggest source of the U.S. deficit. Now, China accounts for about 17 or 18% of U.S. imports. So if India and the U.S. manage to sign a new FTA, then the benefit to the U.S. will be that there'll be another labor surplus country that is able to produce many of the same things that the U.S. currently imports from China. Initially, perhaps at a slightly higher price in India than in China, because we don't have zero cost of capital in India.
Scale up, yeah.
But if once you start scaling up that production as a result of greater market access to the world's biggest economy, the US, then a scaling up, and that scaling up, I think, in India's case, is possible because India has just recently altered its labor laws in September 2020. The labor laws haven't become hugely beneficial to employers, but there's been substantial incremental positive change, and there's been a codification and simplification of the labor laws. So enforcement and compliance will become a lot easier than they used to be in the past. So the license Raj, effectively, of the labor inspector license Raj will be liberalized to a great extent. All of that means that I think there is now the scope for large-scale manufacturing of labor-intensive products like textiles, garments, shoes, toys, processed food. These are types of things that a big labor surplus state like Uttar Pradesh could really focus on. And now that the Uttar Pradesh election is behind us, we have now a state government there that has a 5-year mandate. And I think that is one state that I'll be watching closely to see how much progress they can make. Similarly with Bihar and UP are two massive labor surplus states that should be producing labor-intensive manufactured products for the world. And if there's an FTA with the United States, that would be hugely beneficial. Now, remember the Trump administration withdrew the generalized system of preferences. That affected about $6 billion of trade between India and the US. But just simply restoring the GSP itself would be a huge benefit. So now the problem with the Biden administration, it's a pretty left-wing administration. It's a liberal administration. Biden himself was a centrist when he came to office, when he ran for the presidency, but he is under pressure from the left of the Democratic Party. And any FTA with the US is likely to have a lot of labor and environmental standards included in the FTA.
Right.
Which, interestingly, on the environment, India is probably moving faster than anybody could have imagined. India has made many more commitments on the environmental side than could be imaginable 10 years ago. And so the environmental side may not be too much of a problem. But the so-called labor standards, I think, are slightly hypocritical. And it's difficult for any emerging economy to seriously talk to the US about an FTA if they keep insisting on some sort of labor standards, including some sort of very high minimum wage, etc., which makes no sense. So I think it'll be difficult to negotiate a broad-based FTA with the US, but it is possible, I think, for India to negotiate an FTA with the US that'll be an early harvest deal focused on things like restoring the GSP, liberalizing some tariffs on both sides. India could liberalize some, for instance, on Harley Davidson motorcycles, etc. There could be you could give a few concessions, and that some sort of early harvest trade deal is the best thing that can be expected from the US. Now, The UK, on the other hand, is small country. It's a small economy now, of course. It's outside the European Union. The UK desperately needs India. Now, interestingly, India has a bilateral trade surplus with the US, European Union, and the UK. If there's to be an FTA, I think in general it should be positive for both sides. But a prospect is that there will probably be one with the UK quite soon, simply because the UK needs friends. It needs replacements for the EU now that it has left the European Union. And India is one of the main friends that they're seeking. So Boris Johnson is not in India for just a holiday. He is here to try and boost in India-UK business ties. And of course, ironically, in a reversal of the historic relationship between India and Britain, India is the second largest investor in the UK, and Indian companies are either the second or the largest foreign source of employment of Britishers. So in the UK, in fact, if there's a single corporate group that's the largest employer in the UK, it is the Tatas. From steel to tea to of course TCS, the whole thing. So plus, if ArcelorMittal has a big presence, Vedanta has a big presence. So these are all, there's a large number of significant Indian companies that have a very large presence in the UK, in the real estate market. You walk around London, you find, some of the best houses in London, Kensington Gardens, etc., are owned by prominent Indians. Anyway, so now the point is, so that's been a reversal of the relationship. Britain actually needs India almost as much, or actually far more, I think, than India needs Britain. And of course, the British now eat more Indian food than they eat British food. So, those are all nice historic positives. But unfortunately, the UK is now a relatively small market, small economy. But India and the UK trade very little. So as the British newspapers keep saying, UK-Belgium trade is greater than UK-India trade. Belgium is a small country, right? But if you're neighbors, you trade a lot more. Nonetheless, there is therefore a tremendous potential to increase that both ways. And if there is an FTA, it could be beneficial. India has just overtaken Britain and has become the 5th largest economy in the world. Britain is the 6th largest. So when the 6th largest economies in the world sign an FTA, it should be of some benefit. But really the big benefit will be if India can get one with the European Union, which of course is a much larger economy.
One last question, Mr. Basu. What has really caused the economic crisis in Sri Lanka, and do you see an end to it soon?
Well, the economic crisis in Sri Lanka started really with the first Mahinda Rajapaksa presidency. Now, Mahinda Rajapaksa, of course, was the president who ended the long civil war. So he was seen as a military hero, and he then was supposed to use the so-called peace dividend to generate a rapid increase in economic growth. And in fact, during that 10-year period, 2005 to 2015, Sri Lanka had its best years of economic growth. Real GDP grew at nearly 6% a year over that time. But that period of growth was almost exactly like India's growth in the 1980s, and especially from 1985 to 90. During the 1985 to 90 period, India also accelerated a little bit, but it accelerated through borrowing, external commercial borrowings. Now, Sri Lanka used to borrow primarily from the IMF, World Bank, ADB, etc., which are relatively cheap sources of external funding. It moved away from cheap external funding to borrowing from commercial sources. And in particular, it began to borrow a lot from China. About 10% of its external debt now, Sri Lanka's about 10%, a little over 10% of Sri Lanka's external debt is owed to China. And China puts in place certain covenants in the loans that they make to developing countries, under which if you cannot repay China, then China has a right to take over those assets. It's called, the financial term for this is a debt for equity swap. So they've given you debt. If you can't repay the debt, they take over the debt and make it equity. They begin to own. So famously, of course, they own 68 square miles around Hambantota port. And so 68 square miles of Sri Lanka in the heart of the territory of the Rajapaksa family. Rajapaksa family comes from Hambantota in southern Sri Lanka. They have effectively given that 68 square miles to China for 99 years. But remember, the new territories of Hong Kong were leased to the UK for 99 years as well. So essentially the China is now behaving towards African countries, Asian countries, poorer countries around the world, exactly as Britain behaved towards China and other parts of Asia during the colonial period. So they're doing the same thing. They're slowly trying to take over a country. And now, what has happened? So that's the long story. Now, the short story is that in the last 2 years, first of all, in 2019, Easter 2019, there was a terrorist attack in Sri Lanka and several of the main tourist sites. An Islamist terrorist attack occurred. And as a result of that, tourism plummeted in 2019. Now, unfortunately, if you think about the Mahinda Rajapaksa 10-year period, they borrowed quite a lot. If you borrow from commercial sources, what you need to do is also reform your economy, structurally change it so that you'll be able to repay that debt. One way to do it is to move away from dependence on tea and tourism. Now, Sri Lanka has just two sources of export earnings, tea and tourism. So it's a little bit like Assam. If you think about Assam, Assam has tea and tourism plus oil, right? Sri Lanka does not even have oil. So Assam has tea, tourism, and oil. Sri Lanka has just tea and tourism. A little bit of textiles. It did not reform its economy enough to be able to repay the higher cost debt that it had taken on, not only from China, but from other commercial sources as well. And so when COVID happened in 2020, the second tea, tea is fine, okay? Tea exports are still continuing, but tourism exports collapsed. And the collapse of tourism exports or tourism earnings, tourists coming into Sri Lanka, meant that Sri Lanka going into an enormous amount of trouble. And this year, ironically, towards the end of 2021, tourists began to come back a little bit. But most of the tourists that came back to Sri Lanka were Russians and Ukrainians. So the Russo-Ukrainian war has been the last, the last straw that broke the camel's back, unfortunately, because this one, now that a lot of Russian and Ukrainian tourists are stranded in Sri Lanka at the moment, but the prospect of others coming in is gone. So, you have all of this, but there's been a build-up. I did a study for the ADB about a year ago of debt sustainability across Asia for all the developing member countries, and the two countries that stood out as the most problematic across Asia was Sri Lanka and Pakistan. So, exactly the ones that are in trouble now. I mean, it's so obvious. And they keep having to go back to the IMF. And both these countries, it's ironic because Sri Lanka, if you think about Sri Lanka at independence, it was far more prosperous. Per capita income in Sri Lanka was 2.5 to 3 times India's. So it was much more prosperous, but unfortunately, the first act within 2 months of Sri Lanka coming into being is they passed a new citizenship law that disenfranchised half the Tamils of Sri Lanka. Half the Tamil Hindus of Sri Lanka were disenfranchised, and they were to be expelled to India because they were called so-called Indian Tamils. They were the plantation workers who had built the tea economy. The tea economy of Sri Lanka had been built by Tamils who had been taken there as indentured laborers 150 years before independence, 100 to 150 years before independence. And, from the 1800s onwards. And they had lived in Sri Lanka. They had no ties left to India, but they were to be expelled. And a lot of them were, so that caused the breakdown of Sinhala Tamil ties. And ironically, if you look at the Sri Lankan flag, the flag of Sri Lanka is the flag of the Kingdom of Kandy, the last kingdom of Kandy, which is the last part of Sri Lanka to fall to British rule. And the ruler of Kandy was actually a Nayak from Vijayanagar. He was for 5 generations, the Nayaks of actually from, not so much from, they were formerly Vijayanagar, but they were actually imported from Madurai. They were and it was a Hindu Tamil king who was responsible for the Buddha's tooth relic in Anuradhapura. So, this is the history. Tamils and Sinhalas lived together as one nation, but unfortunately, they broke it all apart within 2 months of independence, and and the consequence has been negative. So, the immediate reason for the crisis in Sri Lanka is economic. The explanation I gave since 2005 of taking on too much external commercial debt. But the longer term reason is the breakdown of ethnic ties between the 2 major communities that together make up Sri Lanka. So, and unfortunately, the Rajapaksas have, if anything, made it worse during their presidency, and so they are now becoming more and more dependent on India to survive economically. India is providing a lot of assistance, but India has also quietly insisted that they must turn to the IMF because they are not in a sustainable position, so they have to turn to the IMF. And the IMF is going to reverse a lot of the economic policies that Gotabaya Rajapaksa brought in since becoming president in November 2019.
Thank you, Mr. Basu, for sharing such deep insight into the macroeconomic scenario that's currently going on and the way forward. Thank you for your time.
Thank you so much.
Thank you.